Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. In today's video, I have two exciting companies. Those two are dividend aristocrats. They are in the basic material sector. And what I want to do is I want to give you an overview. But before I do that, if you have not liked the video yet, please give the videos a like. It really helps the channel and it kind of gets me motivated to do more videos for you guys. So thank you for doing that. Now, before I started the whole video, I want to make sure that we talk about, the main news for today, because the market will open in about an hour or so. Once the market opens, okay, you might see a dip in the overall S&P 500. Why? Because Apple has missed both the EPS, earnings per share, as well as the revenue. Okay, Amazon has actually missed the earnings per share, but they actually beat their revenue about 8%, 8.6% year on year. Now, Alphabet and Google, for example, has also missed both. Now, this is a little bit dangerous because three of these companies, well, just combine those three together, they are like, I don't know, 15% of the S&P 500. So if they all go down, then it's going to be doom and gloom day. But guess what? It's a good investment opportunity for people like me and you who would like to buy companies, great stocks for a cheaper prices. So let's see what happens, but I'm hopeful that they will do all right. But if they don't do it, then overall market comes down, then I'm happy to buy a little bit more shares. Qualcomm reported last night as well, actually didn't do well. They were down in terms of revenue. They didn't do as well as they should have because of the mobile phone situation with Apple. Okay, Apple actually impacted all the other companies that Apple uses in terms of chips, in terms of other devices. Okay, right. So the company we're looking at today, the first one out of the two, is Air Products and Chemicals. This is one of the companies I own in my portfolio. This is one of the largest supplier of hydrogen and helium in the world. This company has generated $12.7 billion in revenue last year. Okay, they work with a lot of different companies in the different industries, including chemicals, energy, healthcare, metals, and electronics. So they are one of those companies that are every single other company out there that manufactures any sort of a product uses. Okay, they need some of these gases to manufacture these things, right? So currently trading $295 per share. It has EPS of about $10 and a market cap of $65 billion. It has a narrow economic mode and it has a beta just below 1, which is absolutely fine. EPS and forward EPS, current and forward trailing and forward EPS basically are both very high. And when you look at it in comparison to the sector, the sector is quite low. But when it comes to these two metrics, this company seems very, very much overvalued at the moment. But 5-year average, okay, the PE average tells us it's actually not as bad, okay. I mean, it should be 26, 27, 28. There's not much of a difference. So it's been trading this. In terms of price to free cash flow, and I mean, something that I'm going to talk about in a second, this company seems very expensive. Why? Because it has I think it has 300 million in the bank right now in terms of free cash flow. That's probably one of the reasons. In terms of dividend, and I'll talk about more about that in a second. In terms of dividend, we're looking at 2.37% of dividend yield. Latest increase was 8% and the 5-year growth rate of 11%. Payout is $7. So every share of this company that you own, you get $7. Now, dividend growth history was 40 years. Now, this company right now are Dividend Aristocrat, which is a company that has increased its dividend 40 years, basically 25 years in a row. This one has done 40 years. So 10 more years, this company will be a Dividend Aristocrat. Payout ratio, we're looking at 61%. And this is something I'm going to talk about now. If you look at the current free cash flow, it's not a lot, but it's enough to cover that dividend. That's why dividend safety is 95%. If the payout ratio goes above 70, 75, I will definitely be selling this company, because one thing that might happen is they might start cutting their dividend. And right now, although if you look at their price appreciation in the last 10 years, they've actually returned almost to 200 something, closer to 300% in terms of price appreciation. I would love to not worry about the dividends being cut. So if that happens, I might look into selling that and taking some of the profits, right? Free cash flow yields, obviously, because of this, is almost non-existent. Now, in terms of profits, we're looking at about 17.8 profit margin, operating margins of about 18, return on equity 16%, total return in the last 10 years, we're looking at 15% as well. And then in terms of revenue growth, and so compounding annual growth of the last 5 years is about 9%, which is absolutely fine. Current ratio is above 1, which is really good. Normally we're looking for 1 or more, so it's 1.8, which is absolutely beautiful. In terms of growth, in terms of revenue growth or earnings growth, sorry, it will be 10% next year. So according to the analyst, next 5 years, ever since of 2013, 14 onwards, okay, we're looking at about 11%, which is quite decent for this type of business. Okay. Looking at simply Wall Street, which is very bullish on this company, is $647 per share. That's their target. That's 54% up from where it is right now. I prefer Morningstar. That's about 10% up. TipRank is about 10%, and Seeking Alpha about 12%. So I prefer this. This is more modest. This is what I would go with instead of this craziness. I don't know why that is too. Anyway, maybe the evaluation is they just bullish on that company, and according to Seeking Alpha, is actually buy. From a Sharia compliance side of it, is absolutely perfect. You got 100%, 16%, 6.4%. In terms of outstanding shares outstanding, basically they have increased that over the last few years, but for 3 years now in a row they have not increased or decreased. So hopefully they will start buying back their own shares, but not until that free cash flow grows as much as I would like to. Okay, and so I don't want the company to buy back their own shares or dilute the shares anymore. So just keep it as it is for the next couple of years at least. All right, in terms of revenue, as you can see, it's growing beautifully. In terms of EPS, is also heading the right direction. So I'm happy overall to hold this company in my portfolio. If, like I said, the payout ratio basically goes 75 or more, then I will start looking into selling it maybe, because the dividend safety is 95% and they do have some cash to pay off that dividend. Right now, I'm not concerned about it. The next company we're looking at is Linde. Is the same sort of a company. They are basically in the same industry. They're currently trading $332 per share. EPS is 756, but it has a huge market cap. Okay, in almost 100 billion more than Air Products and Chemicals. It has a narrow economic moat, and it has a beta that's less than 1. In terms of EPS, this is also very expensive. Okay, 43, 23, and then 23 on average. Based on basically the average 5-year average, this seems very, very expensive. Okay, free cash flow, we're looking at about 24, so it's better than the other company that we looked at now, Air Products and Chemicals. The dividend is 1.41, latest increase was 10%, and 5-year growth rate was 7%. Annually, they will pay you $4.68, dividend growth streaks of 29 years. So they are dividend aristocrat heading towards dividend kings. Payout ratio 38%. This is what you want to see. This is really nice. Why? Because the safety is 99% and free cash flow of almost $7 billion, which is really good. Free cash flow now, okay, yield, we're looking at about 3%. So 3.2% more than what we actually require. So from dividend perspective, in terms and also free cash flow, this company is better. But when you look at the EPS, it seems a little bit too expensive. And on also the 5-year average, if it's 27, why is the current PE? In fact, I'm going to double check this because I'm not sure if that is the case. Let me go to Seeking Alpha and go to, because 43, there we go. The forward is 27. Yeah, that information is wrong actually, because that comes from Yahoo Finance. So sometimes Yahoo Finance is a little bit funny, but the current PE for this company is 26, which makes sense, because otherwise it would be really strange to have a free cash flow of 24, but the company is trading. But anyway, so 26 basically is where it is right now. So it's not too expensive when you look at that, and when you look at the 5-year average, it's below the 5-year average that we're looking for. But this data comes from Yahoo Finance, Google Finance, and so that's why it can be sometimes a little bit tricky. Okay, in terms of when we look at, in terms of profitability, In terms of profit margin is really good, operating margin is fine, return on equity is okay. Total return in the last 10 years, we're looking at about 12%, 12.6%. And then revenue growth in the last 5 years, 27%, almost 28% compound annual growth rate. Now, this is way better than the 9% that we've seen with air product and chemicals, and current ratio is just below 1, which means the company might struggle a little bit paying off that basically total liabilities in current liabilities, okay, but they still have that $7 billion of free cash flow if they needed to. In terms of growth estimates for the next year is 8%, and then 8% every year after that for the next 5 years. Currently they are here, according to Simply Wall Street, is actually overvalued so much. The price they say it should be 157. That's completely the opposite of what they said about air product and chemicals, and apparently overvalued 111%. Morningstar is actually the one what I prefer. Like I've always said to you guys, that's a 4% discount right now, 347. That's a bit more realistic. 10% upside, and then almost 10% upside with the others. So these three companies actually more or less are around the same when it comes to the valuations of this company. Simply Wall Street, I do use it just to kind of give you an overview where other companies, what other companies are looking at, just to compare it. Okay, this is just to compare it to show you what they're looking at. You're gonna have to do your own discounted cash flow model if that's what you want, right? Seeking Alpha is saying it's a strong buy right now, and I do agree it's a buy, but I'm not sure if it's a strong buy. Probably if it comes down a little bit more, then I might look into it, because I'll do a quick update of portfolio soon, and I'll explain what some of the companies I'm looking at right now, and Lean is one of those companies, right? Business side of it is absolutely fine. Interest-bearing debt is fine, and then interest-bearing securities is fine. And this is one of the reasons why I'm looking at this company, because debt levels is quite low, the interest-bearing securities is very, very low, and the business model is absolutely fine. They have increased that share in terms of their shares outstanding in the last few years, but so since 2019 they actually have been buying back, which is quite nice. So they've increased it a little bit in 2019, then they started buying back. Maybe they acquired a new business, maybe something else is happening in the company, I don't know what it is, but they started buying back, which is quite nice, right? So the next thing we will look at is the annual revenue, okay, and then as you can see is absolutely heading in the right directions. From 2017 they grew that to all the way to right now, from 11 billion to right now 30 billion, the next year almost 34 billion, then 34.5 billion dollars the year after. In terms of EPS, if you look at it annualized, then is also heading the right direction. So overall is really good. Two amazing businesses that I actually genuinely like. One of the things you're gonna have to do is, if you're interested in the business, go and find out a bit more information about each one of the companies, what they invest in and so on. But I do own air product and chemicals. I have 15 shares. I've had them for a long time. It was up at one point and over £100. It has come down quite a bit in the last few weeks, but it's one of those companies that I'm willing to hold forever. So I'm just going to leave it there, and maybe start dollar cost average. Now it's coming, basically it has come down quite a bit. It's only 7% just a couple of days ago. For the week, about 6-something%. For the month, it's not by much. And when you look at it for the last 3 months, it's gone up about 25%. 20%, sorry, 20.5. So for that reason, I'm going to wait for maybe for it to come back down a little bit more, and Lean I will talk about when I talk about the entire portfolio. Anyway, that's where the portfolio is at the moment, £67,000. I have £500 to invest in the next, basically today and maybe Monday, Tuesday, so on. So I will be putting more money. I still need to put £5,000. I've got February, March to basically do that. So I've got 2 months to add £5,000, and I'm definitely determined to do that, inshallah. We'll see how the markets go. But right now, as you can see, I'm 10% up as we speak right now, £6,000, and the portfolio is the highest it's ever been, basically. Okay, I hope it continues this way, but you know, in the market it will probably be in the red very soon. Anyway, have a wonderful day. Assalamu Alaikum.